Hello and welcome back to On the Brink. Today we have a very timely episode. As I'm sure many of you are aware, there's a number of scandalous claims circulating around the stablecoin Tether and its putative effect on Bitcoin and crypto markets. At the core of many of these claims is an econometric analysis purportedly connecting Tether issuance to changes in the Bitcoin price. Now, there was one infamous paper by Griffin and Shams that covered this, and then a number of other papers contesting or contextualizing these results or just finding completely alternative results. We already talked to Ganesh Viswanath on this show about his interesting paper on the topic, and recently I came across a new one called On the Role of Stablecoins in the Crypto Asset Pricing Dynamics by Ladislav Krištoufek, who's a professor at the Charles University in Czech Republic. Now, Ladislav's paper is interesting because it expands the sample period to a full 5 years, which prior work on the topic did not do, and covers all stablecoins aside from just Tether to examine their effect on Bitcoin and altcoin markets. And to spoil the results, Ladislav argues that the stablecoin issuance generally reflects an increasing demand for investing in a crypto asset as opposed to serving as a boosting mechanism for the price. However, the methodology is somewhat dense and pretty intense from an econometric perspective, so I thought I would get Professor Krištoufek on the show directly to explain his method and to talk through his critiques of the Griffin and Shams paper, which are quite substantial. So please enjoy the episode. Hopefully this leaves you slightly more elucidated on the topic of stablecoins. Let's jump right into it.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $1 trillion, and all of a sudden, people start to worry. So out of this worry, we have something called the Bitcoin.
Well, Ladislav, thank you so much for joining us today.
Hi, thanks for having me. A pleasure.
This is actually the second time we have had an academic come on the show to talk about stablecoins. The first time was Ganesh Viswanath. I don't know if you read the paper he co-authored, What Keeps Stablecoins Stable.
Yeah, I did. I actually cited in the paper we will talk about today.
Excellent. So you have written a paper, not just on Tether, which is obviously, the stablecoin du jour, but you're covering all major stablecoins. And so your paper is on the role of stablecoins in the crypto assets pricing dynamics. I came across this one very recently. Very interesting paper. We're going to get into that, but maybe before we do that, could you tell us a little bit about yourself and your academic background, and how you came to focus on crypto as a field of study?
Yeah. So my major field is economics. I have bachelor's, master's, and PhD in economics, and that's where I work. And mostly, I finished the PhD in 2013, and crypto wasn't really the main part of either my studies or of my research back then. Of course, if it's 2013, it's still quite early in the Bitcoin history. But I got to the topic of Bitcoin crypto in general, but back then it was mostly Bitcoin anyway. In 2013, actually, when I was working on use of online data for economic purposes, let's say, or how these can be used for modeling various economic or financial processes. Because back then there were several papers that used Google Trends data or Wikipedia usage or page views data for modeling the returns of stocks of specific companies. There were several papers about using the Google Trends for modeling unemployment. So how people look for jobs, you can use it as some kind of a quick insight into what people are doing before you see what's actually happening in the market, because many macroeconomic variables are being reported with with a lag of several months, so you can somehow nowcast, let's say, so not forecast but nowcast some of these processes. And I was looking into something that might be interesting and new with that, and I came across Bitcoin quite randomly or coincidentally, but I thought that it would be quite a good idea to see what this back then very new idea, 3-4 years, that is believed to be mostly speculative or like attention driven or interest driven, mostly not necessarily driven by fundamentals. At least back then, it was the consensus. So to see whether these kinds of online data can be used for that, and that's when I first got into it. And my first paper on Bitcoin in Nature Scientific Reports is actually about this. So how to use the interest of people or investors, but people in general, that can be modeled or somehow followed using Google Trends searches or Google Trends data and Wikipedia pages views. And it turned out that these could be used pretty well. And it was, I believe, actually maybe the very first financial paper that got published on the topic of Bitcoin. And by published, I mean like in a research journal back then. So that was how I got to it first. So it was in 2013.
So you've been covering Bitcoin and crypto as a research agenda for a fairly long time. And you've done other papers aside from that first one that you mentioned as well, right?
Yeah. So the first one in 2013 was mostly about this speculative component, and then 2 years after that, I got a second paper published in 2015, and it was from the other side. So looking at the fundamentals of Bitcoin pricing. So whether some technical specifications, in addition to some safe haven properties and other stuff, whether these fundamentals can actually be used to model the price, or let's say interpret or somehow explain the price of Bitcoin. Because back then, really, the consensus still in 2015 was that the price, should be zero, or there is no real value to it. So my idea was, okay, so let's just see, let's get the data and let's give it a fair trial in a way and see what's what. And the results were actually in a way surprising, that not only the attention based variables, again Wikipedia and Google Trends, were important for the pricing dynamics, but also the fundamental variables behind were important, mostly in the long term, which made sense. So that was the other paper, which was quite important. So it was putting both these two things together. So the speculative component and the fundamental component of the price dynamics. And these are actually my two most cited papers now, or at least when I look at scholar citations, these now are the most cited ones, which is quite funny in a way, because when I look back to 2015, that the popularity certainly wasn't what it was in 2017 or now. So I didn't really expect it to be most cited things I have.
Right, but you don't wholly specialize in cryptocurrency. That's just kind of a sub niche, and you have other focuses, right?
Yeah, like my well, it's quite hard to put some main thing I'm doing. As I said, I'm economist, or my main field is economics. I'm educated in this field. My academic career is in that field. So it cannot really be that crypto would be my main research focus. So I had different things. I focus on energy economics or energy finance, where I have various things connected to biofuels, to electricity modeling, and other things. I also have these online data utilization, let's say, in economic and financial processes, and various other things. My research topics are quite heterogeneous, I would say, and it's it would be quite difficult to keep a track in or at an economics department with a sole topic of cryptocurrencies. It has changed a bit in last few years, because now I am a full professor at my institution, and in the Czech Republic, where I'm from and where I hold position, the thing is that you need to the tenure track is not the same way as in the US. So it's not really a tenure, but you need to meet some criteria for becoming a professor, but you also need to present your research in front of a research committee, which is quite heterogeneous. It's for the whole university, and you kind of need to defend what you're doing. And I was quite bold, because my topic was actually cryptocurrencies, which was quite risky in a way, but it worked out. So the times are changing, let's say.
Yeah, you took a chance on, like many of us, you took a chance on crypto, and it paid off. So when you think about your peers, especially in particular other economists and their output and their publications as it concerns cryptocurrency, what's your sort of prevailing attitude towards the body of academic work? Because I certainly have opinions of my own when it comes to being a practitioner and engaging with academia, but I'm curious as to your impressions as to sort of the general quality of academic output as it concerns Bitcoin and crypto.
Yeah, I think there is a huge gap between the practitioners and the academics, which is not a good thing, but that's what happens. And the tricky part is that the publications in crypto, or like the journal, the research journals publications in crypto are quite cyclical, I would say. So they are very correlated with the Bitcoin price, which is in a way funny. But what I find problematic, because I have these two, let's say, historical papers, even though they're just a few years old, but from crypto perspective, these are old papers, 2013 and 2015. So I read a lot of papers for reviews. I got sent many papers for reviews. And what I find really problematic is that there are many papers. I'm not saying all of them, but many papers are in a way just, let's take the data. There's loads of data for crypto, and let's treat it as standard financial assets that we know, and let's just utilize or use a methodology that we already know, that we already used in our papers, and let's just run the data through it, report the results, and try to get it published. Then the outcome is not good, because you really need to provide some added value of your research, and just listing or reporting the results is certainly not enough. And specifically here, where the crypto markets are very specific, they have very specific characteristics that need to be taken into consideration when you are interpreting the results, when you are trying to provide some kind of like recommendations or whatever you can think of. So I think that's quite problematic. So it leads to, again, I don't want to say a huge majority of papers not being good or not as good as they could be, but I think it's a big problem. And there are only several papers that are actually good, I believe, that really understand, or at least try to understand what is going on. I'm not saying, my papers from 2013, 2015, if I had to rewrite them now, they would be certainly different. I've learned a lot from back then. But as you said, back then it was kind of a niche thing. It was like, let's try this. Let's have the data. Let's have some data set. Let's run analysis. But even back then, I actually read about it a lot, and I tried to interpret stuff. and that's a big difference. And that's what actually led me to my to the paper that we will talk about more in detail about the the stablecoins paper. Because as I said, when I was reading all those papers that came to me, many of them had Tether as a standard cryptocurrency, and many of these papers were like surprised that now we have this Tether, it doesn't move, it's not really correlated, so it's surprising. Well, it's not. If you just look up what Tether is and what stablecoins are, that's their definition, right? And when I read, I don't know, like 10-15 papers that had this similar thing, so not even knowing that Tether is a stablecoin, and that it's not surprising that it doesn't move much or at all almost. And I was like, okay, so let's try to do it a proper look. Let's try to figure out what's going on there, whether there is a research question that might be interesting, and try to do that. So I was like sticking to my research strategy, which is if there is some controversy and there is data for it, let's give it fair trial. Let's perform the analysis, and let's see what's going on. And that's what led me to this paper.
Got it. So before we get into the paper, to address your critique of sort of academia as it pertains to crypto, I mean, how would you recommend that academics give a fair treatment to the crypto industry? Is it a matter of coming in with an unbiased perspective? Is it a matter of actually becoming a market participant and, playing around with these protocols, or talking more to folks that are active in the markets? What would you recommend there?
I think it depends. It kind of depends on what field you're in. Like from the perspective of economics, so not computer science, or really getting into because I don't think that for economists is really necessary to get into the protocol details. Even though economics now is really like getting close to data science and these things, still it's not computer science. So that might be a bit problematic. But I think that what is needed is to take your time in a way. Spend some time in the field. I'm not saying that people must or need to play with their money in the pool, but it's certainly motivation. Like, I mean, if you have something invested, you probably want to know about it, and then you can use it in your papers, in your discussions, and similar things. It will make your paper better, I believe. But it's not necessary. I think even just getting into some crypto-oriented groups, I don't know, even Facebook or Twitter, something not super specialized, but still getting the feel what's going on in the crypto sphere, and what the ideas are. Even though I think that in general the people that are there for a long time, that know their stuff, the technical stuff, they are not necessarily friendly towards newcomers in a way. They can be like arrogant and not really telling you if you're asking and stuff like that. But that happens everywhere anyway. But I think it's that's the time is worth spending there, at least seeing what the mood is, and it will lead you to other things. You start Googling about stuff, you start reading some blogs about it, you get to people who are practitioners who know about it, and you can just filter the information, get to the bottom of it, and then actually use it for telling a better story in your research. Because research is not just about running an empirical analysis and presenting or reporting the results, but it's mostly about telling a story and having something to come out of it.
So your paper on the role of stablecoins in the crypto assets pricing dynamics, when you were inspired to write this, was it in reaction to the existing literature, or did you just kind of feel that it was an interesting question to consider?
The second thing, it was what I talked about before a bit. So it was more a reaction to the fact that it seemed to me that a lot of people don't really in a way care what Tether is. They don't reflect on it in their analyses, at least some of the published papers or the papers I reviewed. And of course, the second thing was that there was this speculation, or this feel that Tether is just a price booster or something like that it's being printed out or issued without any backing or stuff like that. So these two things mainly. So it wasn't really a reaction to an existing literature, because there is not much of the literature on the topic, actually, at least in standard research journals. So it was more of a reaction to that.
So tell me about the approach you use. I thought it was notable that you took a long sample period and you not only considered Tether, but a large number of stablecoins. So maybe in plain terms, tell us about the statistical methodology that you used.
Yeah. So the methodology is actually quite simple. So the idea was to check whether really the issuance of stablecoins, or Tether, but stablecoins in general, even though of course Tether is like large proportion of all stablecoins that are out there, but overall to check what is going on there, in the sense that if the to see whether the stablecoins issuances are driving the prices of other crypto assets, or whether it's the other way around. Because the idea was that if really Tether is just being used as a booster of some bull run or something, then the issuances should come before the price increases. But if it's more of a sign of increasing demand into investing into crypto assets, so people want to get into it, so they see that the prices are coming up, so they try to get onto this FOMO train, and they just want to invest, so they purchase USDT or some other stable coins, and they get to the market. So the prices would come before, or the price increase would come before there is an increase in the number of stable coins in circulation. And for this, there is rather standard methodological approach towards that in econometrics or time series analysis, and that's either a vector autoregression or cointegration analysis or error correction model. So that's what I used. It in plain terms, it really just studies what comes first, or what's the impulse variable and what's the response variable. And when I ran the analysis, I had several robustness checks, because it went through a standard review process. So the referees ask for various things, which are all now in the new version of the paper on the SSRN. And it turns out that really, for pretty much all the cases, it's really the case when that the price increases come before the stable coin or stable coins issuances. So it really seems, based on this analysis, that the issuances of stable coins are really more a sign of increased demand in investment into crypto assets, than that they are being just printed out to boost the dynamics. Because the thing is that this methodology allows for these impulse response functions, where you see how a shock into one variable gets translated or transmits into other variables. And really, there I found only the shock into Bitcoin and altcoins. I split it into Bitcoin and altcoins, gets transmitted into the capitalization of the stable coins, and not the other way around. So that's what I found there.
Yeah, so I'm looking at the paper right now, and you have these great charts of the impulse response functions, and I think the really key one is the stablecoins into Bitcoin. So it's the chart measuring the effect of stablecoin issuance on is it the price or the market cap of Bitcoin?
It's the market cap.
On market cap, yeah. So it's basically a flat line. So what that one shows is that as stablecoins are issued, it doesn't really have a material effect on the price of Bitcoin. Is that sort of the right interpretation?
Yeah, exactly. Like if you're probably looking at figure 2 there. So so the flat line where it says stable coins and then right arrow to Bitcoin, it means when there is a shock into stable coins. So if there is some either increase or decrease, depends of course on the sign, there is pretty much no reaction in Bitcoin capitalization / price, because of course these are not the same as we all know, but the differences are not huge. The thing was that I used market capitalization for all the assets there, because first I had a set of stable coins, and for them to use prices that doesn't make any sense. And then I have a basket of altcoins, and for them you need to construct some kind of an index, right? You don't have a price, so I just took the capitalizations, because that's pretty much the only thing you can do, because it's practically an index where you are weighing with the circulating supply. So that's what you can do. But so that's from stablecoins to Bitcoin. But when you look at the same figure diagonally, so bottom left, you see the other direction, so from Bitcoin to stablecoins, and you see this nice increasing line, which gets to the effect of almost 1, actually around 0.8. So the transmission from Bitcoin to stablecoins is not perfect, but it's very strong. It's in the same direction. So if the price increases, then in several days or then also months, there is a long-term effect that leads to the increase in the issuances of stablecoins. So these are two nice examples of what this analysis can do. So you see a flat line or almost a flat line for the effect from stablecoins to Bitcoin, but you see very strong and monotonous and positive effect from the Bitcoin increases to stablecoin or stablecoins issuances.
How would you explain this? An increase in the price of Bitcoin increases the float of stablecoins.
Yeah, well, the way I see it is that it's mostly the effect of the FOMO effect in a way. So people see increasing prices, so they want to get into the market, so they are purchasing, or they are trying to get their money in, and they are doing it through stable coins. So that's what leads to new issuances, because there is demand for them.
So in the paper, you also talk about the somewhat infamous Griffin and Shams paper. You discuss their model, and you guys don't have the same exact methodology as they do, but you cover it. Maybe just before we talk about it, so their paper was published in the Journal of Finance. For our listeners, tell us a little bit about the credibility. I mean, that's a credible journal, right?
Yeah, that's like pretty much the top journal. There are two top journals in finance, and that's Journal of Finance, so that's this one, and Journal of Financial Economics. These are two like top-notch journals.
The fact that it's a high-quality journal doesn't mean that it's impossible that there are sort of results which aren't good in the papers. I mean, that doesn't preclude the papers from having mistakes, right? Although it just means that that's less likely, right?
Yeah, well, it certainly means that it's less likely. It's also less likely that some marginal topic, let's say, would be published there. And crypto, certainly in 2017 and 18, when this paper was first, I think, published as a preprint, was still quite marginal. So it can happen that it can get through, even though it's not perfect, and that might be because there are not enough, let's say, specialists in the field that might identify what the problematic parts are. Because I mean, methodologically, from a big picture perspective, the paper is quite sound, I would say, or it looks good, I think, or if I can get more into it straight away. The methodology is quite nice. It has networks, it has crypto, so it's really sexy in a way. And that might be tempting for journals to publish it. And I'm not saying the paper is bad. I don't think it's bad, but there are certainly some problems.
Yeah, so let's dive in. I mean, you have an extended discussion of the Griffin and Shams paper. That's certainly the one that gets cited in the press the most. I've read the paper. I have my own issues with it, but yeah, really curious to hear about your critiques of the paper.
Yeah, my biggest issue with it probably is the for the listeners, the paper is trying to distinguish or identify whether there is what they call a demand pull or supply push effect of Tether on Bitfinex. I think they were focusing on Bitfinex and the year of 2017, and whether Tether was just a boosting mechanism for that. And the issue is, at least from my point of view, is that these two approaches or hypotheses are not really given an equal ground. I would put it, because for the supply push, there are 5 hypotheses that they are testing later on, and they are, from my perspective, quite nicely specified, even though I kind of suspect that they are kind of like post hoc created, but still, well, I don't want to say why not, because it's not why not, but still, let's say I can get over that. But on the other hand, there are just 2 hypotheses for the demand pool, and they are both of them, even though in my paper I get more into the troubles of the first one, but both of them are quite problematic, because the first one pretty much models the flows, the inflows into or inflows of Tether and Bitcoin into Bitfinex with respect to Tether's price or returns. So econometrically, they have the dependent variable of either the Bitcoin or Tether flows into this exchange, and they are trying to explain it. So the independent variables are returns of Tether, and that's quite problematic. The reason why they do it is that they assume that the returns of Tether somehow reflect the demand for Tether, which by itself, well, I'm not sure if that is true, right? So if the demand for Tether is high, whether the price actually increases because it gets pulled back to 1 anyway because it's pegged. So that's one thing that by itself it's a bit problematic to have it like that. So then you have this joint hypothesis problem, that you are testing a hypothesis that again assumes something that is not axiomatic, or that is not generally agreed upon. It's something that would need to be tested also, whether it's true or not. So then when you reject or don't reject the hypothesis, the original one, you're not sure whether it's because it's really like that, or whether it's because your underlying hypothesis that's hidden in your second level hypothesis is actually true or not. So that's one problem. But even from technical perspective or econometric perspective, the trouble is that, as we know, Tether is a stable coin. It's pegged to US dollar, so its price is not always 1. It's not exactly 1, but it's very close to 1 almost all the time. So the returns or the price changes are very tiny. So they are practically 0 all the time, very close to 0. And that's a problem, because standardly in econometrics or in empirical analysis in general, if you're trying to explain some variable with some other variable or variables, you want these explanatory variables to have high variance or high variability, because then you cannot explain much if your variable that is explaining, in this case the Tether flows or Bitcoin flows, if it's the same all the time. You cannot get any information from that. So then the methodology can very easily take it as a constant term, and you standardly already have a constant term in your regression. So then you have something close to two constants, and not surprisingly, then your result is that these tether returns, are not statistically significant. But it's not surprising, because there is no variability in this variable. So that's something you would expect normally, and then using it to quite strongly claim that this is a proof or a sign that there is no demand pool is a bit questionable, let's say. And the second hypothesis there is also relatively weak, but I don't want to get in too much detail in that. I think the first one is the most problematic one. I think it might be actually interesting to try to do to replicate their study using the data, using newer data, and trying to come up with some better hypotheses for this demand pool part of what they are telling, because it's in a way discriminating against the demand pool hypothesis, because the testable hypotheses they are presenting are weak or problematic from my point of view.
Right. So if I can summarize maybe, so the way they approach the topic is they set these hypotheses sort of opposite to each other. So on the one hand, you have the demand pull hypothesis, which is kind of, let's call it the innocuous story, whereby there's demand for tether and that causes the issuance of tether. And then you have the supply push hypothesis, which is let's call it the nefarious story, which sort of would suggest that there's, some funny business going on. And what you're saying is the way they specify the demand pull hypothesis doesn't really do it justice. And so it's not a surprise that they don't find evidence for the demand pull hypothesis in the data, thus kind of tipping the scales in favor of supply push. Is that it?
Yeah, exactly. Exactly. You put it nicely. Way better than I did. Yeah, it's that's exactly what I was trying to say.
Yeah, so that's quite interesting. I mean, but you didn't find anything like any glaring or like statistical mistakes in the paper. It's just that you find that the methodology is maybe not fair.
Yeah, well, it's unless you have the data and you rerun the analysis, it's quite difficult to say that there is some huge issue with that. I think that the biggest problem really is that these two sides of the story are not given the equal treatment, and that's the biggest trouble, because in reality both sides can be correct in a way, right? There can be some interaction. Both things can be part of the story. Why not? Even if if you find it, if you give it proper treatment, if you're being fair, it can be the outcome. I mean, the markets are not the same all the time. Year 2017 was really special, let's say, or parts of it were. So it might be the case that these two things were happening at once. The tricky part, of course, also is that there can be some endogeneity issues and some other things that might be worth deeper examination there. But I'm not saying that that it's either demand pull or supply push. It can be both at once. But you really need to treat them the same way, or the starting point for both sides of the story should be the same, and not, as you said, tipped towards one of them. And I have this feeling that they are not really given the fair trial there.
So based on your study, I mean, do you feel that Tether influences the price of Bitcoin, or I mean, to kind of summarize everything, does your study kind of suggest that there's any unbacked issuance of Tether, which is kind of buoying the price of Bitcoin?
There is one part of the results I have there that, let's say, partly go in hand with what Griffin and Shams are saying. And that's that when there are some corrections, in Bitcoin price, or when there were corrections in Bitcoin price in 2017, that there were negative corrections, then there was an inflow of tethers into the market that kept the bull run going. But the question is, that showed in the charts with this negative dip at the very beginning of these impulse response functions. But the effect is way weaker than the effect coming from Bitcoin to the stablecoins. But the thing is that this is a little bit tricky, right? Because you can interpret it as tether being issued to keep the bull run going, but you can also interpret it as that people were trying to buy the dip. Right. So people saw the correction. So they said, OK, so it corrected 20-30%. So let's buy more for cheaper because the bull run is going. So it's not really clear which way you interpret it. You can interpret it both ways. And again, if you're leaning towards one, it is easier to say, OK, it's like that. But again, it should be given proper treatment, see it both ways, because even now you can see all those buy the dip and blah blah blah, these things that we all know about. But if you have this empirically, you cannot really say which part of the story it is, unless of course you really see what is going on inside Tether or other stable coins. We are all just trying to get as much information as we can from the data we see or data we have.
Yeah. So what would be the kind of headline takeaway that you would invite practitioners to take from your study?
Well, I would say that stablecoins reflect the demand. That would be the very short version. The longer, of course, would be that it would be way longer. Of course, that's for people to read the conclusion maybe, or the discussion of the paper, because it's never that simple. But the main point of my study certainly is that it seems way more likely that the issuances of stablecoins are more the reflection of an increasing demand into investing into crypto assets. And I don't really find evidence of this supply push or of this boosting mechanism that will be going on, because there is a specific type of dynamics or of the shape of these impulse response functions that I would expect if there is this kind of dynamics, because both parts of the story can be true, that there is some kind of a push and also a pull, but you would see some kind of a spiraling effect. That's what I actually found way back in 2013 with this Google Trends / Bitcoin paper, where there was some like self-boosting mechanism that the prices were increasing, the people were more looking into it, buying more, so the price was increasing, so there were more people interested, etc., until it collapsed. And then there was this huge correction. So that's something we might expect there. That's the thing that I saw or I presented in this paper in 2013, where there was this self-boosting mechanism, but there's nothing like that in the results there. I find not even a hint of that. So I'm quite. It seems very unlikely. I don't want to say it's 100%. It's statistics or it's econometrics. It's research. It's science. It's never 100%. It's a hypothesis that you test. You have some level of confidence. But I'm quite confident, or very confident, based on these results, that the tethers are not being printed just to boost the prices. They really seem to be the reflection of the increased interest into investing.
So, but in the paper, you don't really take a stance on, and it's not even necessarily testable, what the quality of the backing is of those tethers, whether they're fully backed or under reserved or unbacked. You're not even necessarily taking a view on that particular side of the debate.
Well, I certainly mention it and I talk about it there, because I think it's of course very important thing for this kind of discussion. But I don't have this information, right? No,
Yeah.
we don't have it in general. So until we have some audit, we will never know. But I present some expectations, what I have about the dynamics I would see if it's not backed, if it is backed, and so I have this kind of a discussion. So, and in the end, I find the dynamics that I would expect for no shady business, let's say.
All right. So we've covered your paper. We talked about Griffin and Shams. Are there any other papers on stablecoins that you particularly like and you think are elegantly done and sort of fair to the subject matter?
That's quite hard question, I would say, or quite difficult question to answer, because there are really not many papers on stablecoins. I did some standard literature review on it when I was writing the paper, because I actually at the very beginning I really wanted just to write a very short paper, so letter kind of a thing. But then I got into it and it got really interesting, and I wrote this standard length paper with a story behind. But most of the papers on stablecoins are either like legal or more like background stories, and there are not many empirical ones, or certainly not many empirical ones I would suggest much. Some of the ones I would suggest I have in the paper there. So certainly the paper that you talked about before by Lyons and Wiswanath Natraj, that's certainly a nice paper. There is a short paper by Wei from 2018 that I talk about that they actually don't find this supply push either. Even though that's not it's not that popular of a paper. In general, at this point in the literature, it seems that stablecoins are not yet the center of interest. I would say these papers are not cited a lot. We are still in the phase when the papers that are closer to standard financial econometrics are more popular. So like portfolio diversification, some trading strategies, and these things are still more popular. But there are newer papers about central bank digital currency, so these CBDCs, and even NBER are presenting or are publishing some papers. So I think the train is starting in a way, but still there are not many papers on stablecoins. That was one of the motivations actually, because as I said, the idea and the methodology I have in the paper is nothing. It's not a rocket science. It's a very simple idea, relatively simple methodology or standard methodology that you would use in financial econometrics. But no one wrote about it, which was or has written about it, which I found quite surprising at the beginning, and that's why I did, because I found the topic interesting and worth examining. And the motivation for me is as always. So if there is some opinion, some popular opinion that seems to be clear cut. So for example, at the very beginning in 2013, Bitcoin is just about speculation. So let's test it. Or there are fundamentals. Okay, let's get the data. Let's test it. Same here. Tether is used just for boosting the price. There is nothing behind. Okay, let's get the data and run the analysis and see what the data tells us. So that's what I did there, and that's what I always try to do.
Yeah, well, I'm glad you wrote it and you took such a kind of a fair and balanced approach. I think this is a real contribution. Hopefully we can get some more eyes on the paper. In terms of following your future work, where would you recommend that people go to follow you and follow your work?
Well, I have I have several co-authors. We have various projects on crypto assets. I got a year ago. I got a project from the Czech Science Foundation about crypto assets, which was also quite risky avenue to try to apply for a grant solely on crypto assets. I got it, so we are working on that. So there we are more focusing on mining. So the environmental effects or possible environmental effects, some comparison between proof of work, proof of stake, and what implications it has, and these kinds of things. In general, crypto assets are just fascinating in a way that or for economists certainly are, from the perspective of that they allow you to study so many things that you normally wouldn't be able to, because there are many theories that assume something or that expect something about the market, but you will not be able to find it in standard financial markets. You either don't find the behavior or you don't have data for it. But then you have crypto assets, and there is this huge interaction between fundamentalists and chartists. You have loads of data, various types of data on high frequency. So you can do so many things there. You just need to think about it and really try to test your hypotheses. So it's a fascinating field from this perspective, that there are so many things that can be done, many hypotheses that can be tested, that you can't test or use for standard financial markets, because they just don't have either the data, or they are too regulated or too standard. Let's put it like that. Because even, for example, the issue of liquidity. I mean, for standard markets, most assets that you trade with, they are just very liquid. So you cannot test many things or examine many things about liquidity. But then you have crypto assets. You have these super wide or super empty order books for smaller tokens or cryptocurrencies. You can study that. You can study market efficiency, which normally you have this assumption that markets are liquid, and then they are efficient. But then you have crypto assets. Again, they are not liquid. So even if you can find some trading strategy, you can try it, but that you just can't buy. Or if you sell, if you sell some decent amount of money, or even like $10,000 for some tokens, you just drop the price by 60%, because you just sell through the whole order book and stuff like that. There are so many things that you can do, and in our most or the closest future now, we are really focusing on the mining or on the environmental effects. I also have a follow-up paper for stablecoins that I will write in coming weeks, which deals with similar stuff like this paper, but from a little bit different perspective. We have some agent-based models that we want to try. So there are really many things we try to do. Various stuff.
Well, I really look forward to seeing your future work on this topic. Ladislav, thanks so much for joining us today. It's really been great.
Thank you very much for having me again.